Hi, I'm Dean Orrico, President and CEO of Middlefield Capital. And today I'm joined by Mark Kenney, the CEO of CAPREIT, which is a long-term, well-respected apartment REIT headquartered in Canada with assets throughout the Canadian market as well as Ireland and Europe. And I'm going to be asking Mark some questions on the status of the apartment sector in his various areas of operation, why CAPREIT is trading at a discount to NAV, and what the prospects look like for CAPREIT going forward. And CAPREIT is a core holding within our Middlefield Canadian Income Fund. It's a name that we actually believe has exceptional value. And I think you'll find this interview with Mark very insightful and helpful. So with that, Mark, how you doing?
I'm doing great, Dean. Thanks for having me here.
Pleasure. Thanks for joining us. So let's jump into it here, Mark. Now, as I mentioned, I've been an investor in CAPREIT for over 20 years, and I think there's probably only 2 or 3 occasions when I've actually seen it trading at this kind of discount to NAV, and certainly well below the highs that we saw in CAPREIT in February of this year, which I think we're through $60, and today the stock is at $50.51. Now, I think people have got varying opinions as to why that is. Why do you think you're trading at these levels right now when, you may have a view that the fundamentals really don't support that?
Yeah, well, I think the opportunity that you've seen in CAPREIT is just an opportunity that's unique to the capital markets. And I say that because we've seen apartments in the private market trading at never before seen levels. You've got Midtown Toronto assets that are selling for 2 caps. I'm hearing now about high 1 cap deals. Okay. And so let me talk about that first in terms of what's happening in the acquisition market, and then I'll tell you what I think has happened in the case of CAPREIT. So never before have we seen the gap between the all-in cost of 10-year CMHC financing and cap rates been this wide. Okay. CAPREIT was in the business since I've been around for 22 years of buying apartment buildings between 80 and 120 basis points above cap rates. Okay, the cost of financing gap between all-in financing and a cap rate 80 to 120. And it's not just about that, it's then about the growth that the asset can then deliver. Obviously, high growth profile assets, 80 basis points, good growth assets, 120 basis points, but it's always been a combination of those 2 things. When you're seeing repositioning assets trading at a 3 cap, let's say, and you're financing a repositioning asset with 5-year money at 1%, that's a huge gap. So that's what's happening in the private market. You've got surging apartment values all over the country, cap rates compressing from coast to coast. But what happened in the case of the apartment REITs is retail, okay? And the institutions were not the sellers in this environment. It was the retail owner that maybe had 100 shares, 1,000 shares, 2,000 shares of any of the apartment REITs, any of the REITs period, that were spooked by bad news for REITs, dominated by retail. Number 2, the presidential election and uncertainty. And number 3, the coronavirus threats and the impacts. All those things together, the highly liquid names, CAPREIT being the most liquid, had a retail sell down. And so what you see is, if you go back and you look over the last month, incredibly low volumes. So our typical trading pattern of call it March and before, we were trading in excess of 1 million shares a day. That went down to sub 200,000. So when there's not a lot of buyers and people are staying still, but retail is spooked, that's where you end up with a disconnect.
Now, so just let's focus on that for a minute, because when we say there's not a lot of buyers, and I'll take it at face value that you've got some retail selling, i.e. weekends falling away, why haven't more of the institutions recognize this? As you say, they understand what's happening in the private market. they're long-term focused. Why haven't they been there to absorb that weak selling?
I think it's just fear, period. Fear of the unknown. The institutions like risk-adjusted returns, and how do you do a risk-adjusted return in this incredibly unprecedented environment? So the nature of the virus is, when is it going to end? And throughout this pandemic, that's what people have been asking me, Mark, when's it going to end? Well, I'm not a doctor, and I know as much as all of us that watch the news, which can be highly misleading. And that was the problem. So I think what you've seen in the last week at least is some sort of settling on the US election and some sort of hope with vaccine. And so then people are thinking, okay, we're now entering a stabilized environment. So what does that mean for CAPREIT? CAPREIT, we've all forgotten, CAPREIT has performed so well because of the affordability gap in Toronto, Vancouver, Montreal. Okay? But apartments by their nature are counter-cyclical. We always do well in bad economic times. And there's evidence of this throughout history. There's evidence of this all around the world. And there's certainly evidence of this in Canada. So apartments are all not the same thing. And what I mean by that is I break apartments today in Canada into three classes. Affordable, which you see activism and you see a lot of political heat and a lot of uncertainty, which political uncertainty is probably our biggest risk in our business. You've got mid-tier, which is where we are, which is the perfect place to be. And you've got brand new luxury. I throw condos in that category as well as brand new purpose-built. They're in trouble. Like those pro formas are under incredible pressure. You can see 20% decline in rents, and all the rents are at market. Where CAPREIT has seen 10% increases in our rents throughout the pandemic. We were 15% portfolio average increase in rents as of March. We dropped to 10, but rents are advancing. And I believe that we'll return to that 15, if not higher, based on the kind of fundamentals that I see coming. And it's the affordability. Our portfolio is $1.60 a foot rent portfolio, whereas the new construction condo market is $3 to $5 a foot rental portfolio. Very different businesses. So I do believe quality, location, and the size of units will be highly rewarded. CAPREIT is a 2-bedroom portfolio, if I was going to characterize it as anything, suburban, large city. And what we've seen, excuse me, is remarkable performance in the suburbs, and the core is under the most strain. The good news for us is we don't have a lot of concentration in the core of any of the three cities.
Now, let's talk a little bit about that, and that you're being, well below where I'd say, new supply is, including the condos, including the Airbnbs. How far do you think those asking rents are going to go on that more expensive part of the market? Do you think that becomes a threat to CAPREIT, that they get anywhere close to $1.60 a foot at any time?
No, I think the majority of that market is condominium. And in that sector, you'll see damage done in terms of valuations, but people will be forced to sell. There's been too much capital appreciation speculation in the condo market, and those buildings are impacted the most, and the cash flows are drying up very fast. So I think that could lead to a condo sell-off, not by choice. And in fact, that will shrink the rental supply in the big Canadian cities, which again will play into CAPREIT. So the problem that we have in Canada is that our rental supply over the last decade has come primarily in the form of condominiums, and that form of ownership can leave the rental pool very, very quickly with a sale.
So let's just dig a little more into demand here. And we know you're at, arguably the lower end of the market, and that's really what supported this 99% occupancy, 99% rent collection right through the pandemic, which, clearly would be an outlier relative to other real estate corporations. And when you look at, again, the lower end of the market, I think, some people might assume that many of your tenants would be benefiting from some of these government support programs that have certainly been a significant factor in Canada in trying to support people in sectors of the economy that, that are basically out of work, and this pandemic may continue. These people might continue to be out of work. Do you have a sense for, what percentage of your tenant base is actually benefiting from some of those government programs, and whether that's sustainable if that's a significant number?
Well, I would first of all make one minor clarification. I would characterize, and the analyst community, I believe, would support this, the CAPREIT being at the high end of mid-tier, okay? And and that is a different place than the lower end of mid-tier, which, as I said before, is a very different place than affordable. So clearly in affordable, that's the most impacted. Less impacts are felt. I do believe we're highly impacted by supports. But I think about it this way. What is the unemployment rate going to be is the first question, okay? And if I go back in time, if you go to the worst point of the Canadian economy, call it late 80s, early 90s, in my career, you would see that unemployment was over 10%, and apartment default rates that CMHC would use in underwriting valuations were 1%. Okay, so that's context. If unemployment is 15% or 20%, it doesn't really matter. And I'm going to tell you why. And it's not a very pleasant topic that people don't like to discuss. But in apartments, we have eviction. And so when somebody can't pay, we have the ability to evict. And we replace those people with people that pay. In the home ownership market, it's much more difficult when somebody defaults on their mortgage to have that person foreclosed on and moved out. So the efficiency of replacing a paying tenant, as much as you hear stories that it can take time, it's incredibly efficient. If somebody can't pay, there's a mechanism to deal with that non-payment issue. And that's what's unpleasant and I think gets a lot of attention, but it's the reality of investment. So it's not even as much as what's the unemployment rate, what's the impact. Our ability to deal with that is quite efficient. And the place that we find ourselves in with $1.60 average portfolio rents, people want to hold their leases. They'll do whatever they can in terms of making payment to hold those leases because they don't want to lose it.
Interesting. Let's talk a little bit more about kind of the government's involvement, because you mentioned this, and really it's been at various levels. One, we've got some government support for tenants, and that certainly supports paying rent. The other aspect has been what I would describe as government intervention. And as an investor, you generally like to invest in businesses that the government is not involved in any way. And so I look at Toronto. We know there's rent control legislation here. We just seen a re-election with a majority NDP in BC, where you've also got exposure. And so tell us why this is, maybe not as concerning a factor as, some people would think, when in fact, we've seen, freezes. Give us an overview of what the status is and your views on it.
It's the number one thing I worry about. And that's saying a lot given all the dynamics that we have in our business. It's the number one thing I worry about. That being said, I'll try to describe the environment. Things are getting better because you've got vacant condos, you've got falling rents, you've got a lot of dynamics that are happening in the marketplace, which should keep government out of our business, okay? Despite that, you've seen this reactionary approach of government. It's a cheap way of winning votes when you brush everybody with the same brush. I got that saying wrong, I think, but
I know what you meant.
Yeah, it should be focused assistance focused on those that need help, not assistance for everybody because there's a pandemic. So that being said, our business has really relied primarily on rents on turnover. Rents on renewal, which is what's been frozen and in BC till mid next year, and in Ontario for all of next year, doesn't have a huge material impact. To give it some context, the entire value of the rent roll effect in 2021 for Ontario, which is where the bulk of our portfolio is $2.5 million. The interest rate savings that we are going to make on mortgage renewal dwarfs that number, dwarfs it. So that the big concern would be, is government going to go back to traditional rent control where all rents are frozen? I sleep well with that because government, no matter what it says, does understand that Canadians are convicted around immigration. And without supply, there's nowhere to house people. And they have always got themselves into the same corner where they want to attack the landlord in the short term, knowing very well that Canadians like to vote for immigration. So at the federal level, and this has been my big issue, which has actually made CAPREIT incredibly resilient and incredibly strong, is that we love as Canadians immigration. That's a federal vote. And as Canadians, we hate development because it's not in my backyard. Right. So there's no national housing policy because the provinces are ultimately dictating what happens. So you've got three different levels of government with one problem of housing that sits in the middle. And this is why we find ourselves in a supply disconnect, is that there hasn't been conviction around that issue for a long time, but the issue hasn't gone away. At the end of the day, the government needs housing. And when you put risk into the equation, investment will go elsewhere. And so I do get a lot of government ultimately does understand that, despite what you hear in the headlines. Yeah. I will say that on the just on the rent increase front, in 2020, CAPREIT and a number of other large landlords, public REITs, we all voluntarily froze our rent increases, and just because we felt it was the right thing to do. The government in Ontario didn't make us do that, despite our urging. So it was a little bit of a surprise when the Premier reacted on a Thursday night to a 1.5% rent increase that was supposed to come to Ontario. But I do understand his rationale, and that's a government that's been good to our industry in the long term. So
let's just talk briefly about CAPREIT strategy outside of Canada. You know, we know you've got some exposure to the UK and Europe. We know, clearly, while we've got challenges here, some might say the challenges in the UK and Europe are actually more severe. You've got a slower growing economy. You've got more issues there. Why muddy the waters here? Why continue to expand outside the Canadian or potentially US market? Just give us your rationale for that.
So a slight correction. We're not in the UK, but we're in Europe. Okay. Right. And we're in the Ireland and the Netherlands. And we were first drawn to Ireland because of what's happening in Canada now, the huge spread between cap rates and interest rates. Okay. And in the case of Ireland, we were able to buy it almost 30 cents on the dollar. If you look at the REIT that we created there, IRES, of which CAPREIT owns just south of 19%, we're the property asset manager and the largest shareholder. That is probably a collection of the highest quality apartment buildings, I would argue, in the world. Now, it's not very big, but it's 4,000, just shy of 4,000 virtually brand new apartment buildings in Dublin. So it's a micro play. We probably made a mistake in setting it up in a structure in Europe. We should have kept the structure in Canada because of the ease of raising capital and reacting to market opportunities that's unique to Canada. But put that aside, to address that, we've created another platform called ERES, and ERES is based in Toronto. It's traded on the Toronto Stock Exchange. Today, CAPREIT owns around 60% of the shares. ERES will grow at hyperspeed. The Dutch market is a very vibrant market that has 4 caps with long-term money at 1.4%. So the spread is huge. And in the Netherlands, there's been a 40-year average of 4% rent increases that the government have laid out. Small turnover. We don't get the mark to market, but we get a much, much higher guideline increase out of the government. And it's a unique story in the sense that we love the opportunity so much that I said to CAPREIT investors, the capital allocation strategy is to not take CAPREIT balance sheet value over 15% in Europe as a total. Instead, give investors the opportunity to capital allocate more. We would prefer to see you move into ERES because we think we'll be there longer. Because Dean, quite frankly, if I wasn't careful, we would have been called Cap Euro in a very short period of time. I think that ERES could grow to the size of CAPREIT in 5 to 10 years, if not sooner. We've seen 10,000 unit portfolios come to market in the Netherlands. We see on a regular basis portfolios from 300 to 1,500 units. So it's a whole long tutorial on a different company, but CAPREIT shareholders benefit in the case of ERES from a permanent property asset management contract. So the fees that come off of that, which will be a very lucrative contract as the scale grows, CAPREIT shareholders will benefit from that fee income because it comes back to CAPREIT shareholders. ERES investors benefit from an incredibly stable investment that we have high conviction over as a sponsor.
So you've presented, pretty compelling story from both the demand and supply perspective. And listen, we've been in the markets for a long time. We know that where there are more attractive returns, you're going to get more players. And we started to see some early signs of that, specifically in Canada, where you finally have some purpose-built, rental buildings. Do you see this as becoming a greater factor over time, or are you less concerned about it?
Sadly, I think we're going to see a slowdown, if not a halt, to new rental construction, because the math was making sense for developers of new rental at $4 and $5 rents, and those rents have come under extreme pressure. And we must remember that when we're talking $4 and $5 rents, we're targeting the $150,000 a year income earner and up, which is a very skinny part of the market. So as those rents fall and that cohort of income earners falls, I think that sector is going to come under a lot of pressure.
So as I kind of wrap all this up, Mark, as I look at where the stock is, we see some pretty attractive fundamentals, low cost of financing, opportunity to acquire some assets accretively. What should I look at in terms of a target price for CAPREIT going out 12, 24 months?
One thing I don't manage is the stock market, but I can tell you this, we're a very different CAPREIT today. As much as we talk growth, it's important to recognize the fact that our acquisition department, which I started when I became the CEO, is now a group of almost 10 individuals. We underwrote last year almost 400 deals and transacted on 13. So we're highly, highly disciplined. I like to tell investors that I have my entire net worth in CAPREIT. Well, I have a car and a bicycle and a house, but everything else is CAPREIT. And my conviction around adding assets is very much around, is it better than the CAPREIT portfolio? So if I'm not buying assets that add growth beyond the profile of the CAPREIT portfolio, why am I buying assets? I'm already the biggest REIT in Canada. So that will continue. But I think with that being said, you will see us act conservatively, but en masse. If we were to take our debt levels from their current place today, call it low 40s, we've got almost $2 billion of acquisition capacity. So we're highly, highly liquid name. Just quickly on liquidity, because people talk about it. Other REITs are valued on their operating lines and cash on hand. CAPREIT is not fully recognized for its easy accessibility to CMHC financing. CMHC financing continues to be available, as I said earlier in our chat, and it really should be viewed as liquidity. And when you look at it that way, our ability to lever our balance sheet is phenomenal. That being said, I'm not that motivated to do it unless the opportunities are really compelling and the capital markets are shut. The one thing I don't want to do is issue capital ever below NAV. I think it's irresponsible. And I think that at a minimum, you should be selling assets before you do such a thing. And we're not in that place at all.
Well, that's excellent, Mark. Listen, I appreciate the time. You've put provided a very thorough overview on where CAPREIT is and why we own it across our portfolio. So basically provided confirmation of the quality of the business, quality of the management. So thank you very much.
Thanks, Dean.